You're going to make a lot of mistakes. The trick is not to make the same one twice. I was undercapitalized. I got caught and I was done. We had some terrifying goals. You just have to keep going. They're raising billions of dollars in an additional share offering. One of the key mistakes I made was being undercapitalized. You have to just follow the money. And there's a lot of money moving around AI. They're all going to tell you they're easy to play with. Not everybody is. Taught me that you never stop raising capital until you don't need it anymore.
Ben, thanks so much for joining me today.
Glad to be here, Doug. Thanks for having me.
One of the biggest things with this show, it's not often we get to have clients, but when we do, it's some of my favorite episodes because we have context, but I always get to learn some of the stories behind the scenes that we never get to hear in the meetings. So, it's an honor to have you on today. I appreciate your time a ton. And the first question, we did some research and you spent most of your career walking towards agriculture, where most people with your resume, they would run to Silicon Valley. What did you see in some of these old physical industries that somewhat might even say are archaic, but you seem to find innovation and unique opportunity in each of them?
Well, I had a pretty unique journey. I grew up in ag in Davenport, Iowa. My dad was one of the first people in the U.S. to do hedging for large family farms. Started that in the 70s. And so I grew up in a commodity trading house on the Mississippi River, literally. And, um, when I graduated undergrad from Iowa State, went back to work for the family and, became a trader. Really enjoyed that, quite frankly. It's a young man's job, but I had a bunch of fun. And then I became our sales lead and had some sales success, kind of my first sales success. And I started my own company at 28 and it failed. After about 3, 4 years at it, I'd made some rookie mistakes. I was undercapitalized. And so I was burnt. I thought I was out of ag. So I left, and that's the MBA. And then I ran towards Silicon Valley. I worked for AMD and other software companies. And I had a mentor call me one day and said, "Hey man, it's time to put your two pieces of your career together, your ag career, which I thought was over, and your tech career. This thing called ag tech could use you, and I think you're uniquely suited for it now." So, I'd like to tell you I was really smart about it, but I think I got lucky.
Well, I find, when you look into agriculture, I see more entrepreneurs, even if it's just the farmers, the growers, people running operations, they're more entrepreneurial and it kind of gets a bad rap. How much did those combined experiences, including the failure, help hone and figure out, hey, now I know what to bring to an industry that's kind of a sleeper?
I've made most of the mistakes possible working in agriculture and technology. I'm 53, so at this point in my career, I've seen a lot of the playbooks. And you're right, ag is very entrepreneurial. It's a lot of family businessmen and women is really what it is, and they work really hard all the time, and they are actually very tech forward. They just don't play around for fun. They don't have time for that. They're not really gadget people most of the time. And so ag, while it's very entrepreneurial, it's also a very difficult market to crack because you say ag and people think farmers. Okay, well, they're spread all over in rural areas by definition, really hard to get at from a sales and marketing standpoint, and hardened as that market is consolidated, they get picked on by all kinds of people, and so they're very thick-skinned about being approached from a sales standpoint. And then you've got large ag, big corporations, some of the biggest in the world. Well, startups have a really hard time, or smaller companies have a really hard time addressing a large company's need. And so that bifurcation of very big companies and very fragmented farmer base means you've got to be super focused on where you're going and how you're doing it. And so, at this point in my career, I've chosen to focus on the enterprise side of the business, the large corporate. Part of that's because I understand it better than I ever did in the past. Part of it's because the business model for what we do currently works much better that way. But that's ag is multiple markets all wrapped up in one. It's one of the largest verticals on the planet. And if you think, well, ag is all farmers, ooh, you're missing a piece of the story, and too many people make that mistake.
How did you take anything from being that growth guy, the scrappiness? How do some of those skills and insights parallel into now going after enterprise?
Well, it's really important for anybody that wants to be in sales to do a million sales calls, and that's only a slight exaggeration. I mean, if you're not talking to people all the time, it used to be on the phone. It's a lot less cold calling and phone than it used to be. Now it's Zoom and in person, and it's transitioned slightly, but the base of it is still, are you interacting with people? Can you learn to listen to what they need and what they're actually saying and what their needs are? And can you learn to react in real time? Because then you learn not just to sell, but you also learn what people need and why they need it and how they talk about it and how badly they need it, and mostly important, what they'll pay for it. So running around and doing all that early sales work informs everything you do later. When you get to enterprise selling, it's kind of the top of the mountain in terms of sales skills. I mean, an average enterprise engagement will have now 10 plus influencers. There'll be somebody that says, I'm the decision maker, but in today's corporate world, there aren't single decision makers very often. They have to check with finance and legal and their peers and the people that report to them and the people that are over them. And by the time you crawl all through that, there's way more excuses to say no than there are reasons to say yes. So you've got to be very focused on value and money and ROI, and you've got to understand the game that you're playing and how to deliver. That takes a few years to hone in on.
Would it be fair to say like the grit comes from like those early years and grinding it out, but the patience comes from like the wisdom and experience of being told no 1,000 times?
I have heard no a lot in my career, and you have to toughen up to that. Like it's never fun. I don't enjoy it. I'm not good at it, but I still hear it quite a bit. And the at the time I was coming up through sales and selling directly to farmers, there were times that I thought I could get my pheasant limit by driving on South Dakota roads because I was on the gravel roads so much every day. Like I've seen a lot of that. I was a VIP at Super 8 for years, you know, just just because of all the road warrior work. And that does teach you to either do something else with your life or to get really good at what you're doing. Those are the two options on the table when you're doing that.
Yeah, it's funny you have those early childhood memories in Iowa. I remember the first job offer I had was with Titleist in FootJoy. They're like, "Hey, congratulations, we're gonna send you to Iowa," and I'm like, "No, not for golf in the winter." Um, Speaking of some of those like long days, I think the biggest growth with enterprise sales comes long term thinking. Like it is not a short sales cycle, no matter how you want to do it. How is some of that planning, like how do you approach that, and where does that patience come from, knowing, hey, we have to meet these quarterly goals, but the sales cycle is a few quarters long? How do you now navigate that with some of what you learned in the past?
Well, I've held multiple sales leadership roles, and you start out at sales and sales leadership thinking, well, it's about the number I have to deliver this quarter, because it is. That's not wrong. But after you've done that for a few years, you realize the only way to have confidence in delivering any quarter is to have a sales pipeline standing behind you that's as big as possible. We talk about pipeline needing to be a multiple of what you're actually hoping to close at any point in time. Those multiples tend to be specific to companies and industries and products, but you want as much pipeline coverage as you can possibly gain at any point to hit any quarter or any year. And so, as a sales leader, you start off early in your career thinking it's about managing the close. Still not wrong, but you learn that a lot of what your job is managing the pipe and constantly filling it and constantly expanding it. Because if you can't do that, then you're going to be very up and down. You're going to hit and clean out the pipe, and then you're going to rebuild it, and you're going to get very frustrated with that hot and cold, and the only way through it is more pipeline.
Perfectly said. Now, I want to switch gears a little bit. You and I have talked a little bit about AI and how that's affecting both pipeline and the industries in general. You've had a pretty interesting perspective, and we've talked about it a few times where everyone in tech frames AI as replacing people. You work in an industry where real labor shortages are generally one of the most dangerous things because you can't exist. Where is your perspective on how AI is going to both impact this industry? How are you leveraging it? Just give us your take on AI to start.
Well, artificial intelligence, because AI can mean multiple things in the agricultural market, but artificial intelligence in agriculture or in any market needs to be split up into two different categories. There's the revolutionary model of building brand new tech. That says we have new tools that do new things in new ways, and it will change the world. So if you're Google or OpenAI or Meta or SpaceX or one of these companies that is all over the headlines right now, you're a revolutionary provider of revolutionary tech. That's a high risk, winners take most type of market. And that revolutionary model is what we generally read about because it creates billionaires. Elon Musk is the first trillionaire. That's revolutionary. A transformational model is about applying new tools to do new things in existing settings. And so there's the companies building AI and revolutionizing what we can do, and then there's the companies applying AI to transform what we do. And those are literally different financial models. They're different risk and reward settings. And what we do, what agriculture will do, what most industries will do is apply new tools to transform their P&Ls and their operations and the way that they do business. And AI can't work if you don't have big data sets. AI's, claim to fame in a lot of ways has been enabled by brand new compute capabilities. And that compute is only useful if you have a compute bottleneck, if you've got too much data to get through and can't use it very efficiently. So if you can throw the compute at a lot of data and be able to structure that appropriately, you can find insights, you can move faster, you can be a lot quicker, you can be a lot smoother, you can save a lot of money. That application can be transformational. And that application requires big data sets. Now, that statement right there, I think will make a bunch of sense to people and they'll go, okay, yeah, I've heard that part before. But if the problem you're working on doesn't have big, clean data sets, you can't put AI to work on it. Like you're cooked right out of the gate because AI's got nothing to chew on. It's got no raw material. And in agriculture specifically, that's a problem because there's areas where ag has really big, deep data sets, and there's areas where it's still very manual. And you have to create those data sets. And generally that means industrial IoT, sensoring up. So you have these data pipes that are always on and always running. And once that's in place, then you can do new things that never before with that data. That's a multiplication type of factor. That's transformational. We have data, it's really clean. We can do things we never could before, and we can apply AI to it to gain insights and efficiencies that we couldn't even with the data. Well, that's kind of one of these 1 + 1 = 3 kind of scenarios.
How have you been able to help people, especially more in a leadership capacity, understand something that's so daunting? I mean, it's just the word right now, and they can't fathom, like, I don't know how to deploy it. We don't even know where to start. It's such a big concept, but what you're doing at BinSentry is a simple leapfrog. How do you distill it in such a simple way to, your customers or just people in the industry? Like, where do they start? I think is probably the biggest question.
Most of them start with, is this serious and does it matter to me? Is this coming from me or is this a headline thing? Because, if you're in the second half of your career, you've seen hype cycles before. And so you start to get some scar tissue and you ask yourself, is this hype cycle? How much of it is hype cycle? Because it's definitely running hot right now in the media and has been for quite some time. And you have to just follow the money. And there's a lot of money moving around AI. But again, is that the hype cycle or is there real profitability being created? Is there new efficiency being created? And there appears to be. So it seems very exciting. And if they say, okay, well, maybe this applies to me, how does it apply to me? And then you go to the basics of change management. Like we need to see results and we need to build momentum with them and we need to be able to have proof cases and projects that show us how in whatever your setting is, whatever your teams are, whatever your problem set is, that it's significantly better. New technology doesn't get to be a little better. Like nobody cares about a little better. Like you're not looking for your third ibuprofen pill when two of them work pretty well most of the time. You're looking for transformation. If you're going to take the time and the energy and the money it takes to play with new tools, there's risk involved. You're already busy. Everybody's already busy. So if you're going to take that time and cut it apart or cut it, reserve that effort, those resources, risk confusing your people or distracting them from something they already have to do all day. The opportunity, the value you have to create has to be a multiple of what you're doing today. Like it's got to be big value slices or it doesn't count. And it's not always intuitive where that shows up until you really deeply understand what your customers are doing. If you'll let me tell a story for just a minute
Absolutely.
here. So when Amazon first came on the scene, it was books and then it got into everything and you could start ordering and a lot of us just weren't. And at the time, my wife and I had two big, dumb rescue labs. Loved them and they ate like crazy. And she would take her a station wagon to the grocery store and buy two 40-pound bags of dog food and drag it back to the house and then carry it into the garage. And she learned one day that she could get on Amazon and get the same dog food for $1 less. And that would show up at the front door, and then she could tell me to move it into the garage. And so it wasn't so much about the I can pay $1 less a bag, although that was cool, and a lot of people focused on the pricing metrics of that movement. It was just as much about the experience for her of I don't have to handle a 40-pound bag of dog food anymore. That's out of my life. That's done. And so very quickly, Amazon became a line item in our budget. That experience of where's the value isn't always intuitive. For my wife, it wasn't about the dollar. It was about not handling, the bulky dog food that she didn't want to handle. The dogs didn't care. I wasn't paying attention at the time. I learned very quickly what had happened when I was moving dog food around. But, that type, I tell that story at times because you get very caught up in the standard metrics. How much money are we saving? How many hours are we saving? What's the result? And you have to do that work. That's blocking and tackling. But the unlocks for the value you give to your customers are usually much more subtle and actually much more important. They're just harder to uncover and harder to communicate. And when you do it properly, that's when you get product market fit and because you take off. Like it shows up in the revenue sales line when you find that fit, and you've got to understand the whole experience. And until you do, um, you get frustrated that people don't understand how cool your thing is yet.
Are there ways, and I know, we're going to pivot into growth. So it's a perfect segue. You've seen this happen before, at Indigo Ag with their growth. Are there signals that you're getting closer, or as a CEO, how do you start to find and uncover some of that?
It starts with being in the room with people when you're telling the story because, when you're trying to find product market fit, you have to be in a lot of rooms, you have to be with a lot of customers constantly. And so you're trying different versions of the story for different versions of the customers. Like what are they honing in on? What do they care most about? And you're playing with the talk track. And you start to know that you've hit it when you can say something ahead of the customer and call the ball on what's coming in the conversation. And in the room, physically, they'll start to nod. They just can't help themselves. Like psychologically, they're going, this guy gets me, understands what I'm working with, and I'm buying right now what we're talking about in this conversation. When they start doing that, when people physically or they start leaning in to say, that's exactly how I was feeling. Tell me more about that. Okay, now you're getting hot. Like that starts to feel really good. And then you can hone that, train the team to it. The only way you ever really know though is revenue takes off. Like the proof is in the revenue.
Numbers never lie, ever. Speaking of numbers, you were part of some pretty rapid growth going from 300 million to 3 billion. What were some of the lessons that you saw, in that rapid growth? What does 10x growth look like? And to be honest, how? How did it happen?
My days at Indigo were very formative for me. I was already in the second half of my career, but we got there and the team was unusually good at being funded. Raised over $1 billion while I was there. I was not part of that effort very much. I'd be occasionally part of some calls, but that wasn't my part of the business. And so we could do what we wanted to. It was a very unique time in history and for the company. And a lot of people say, I wish I was unconstrained as I chase things. Um, be careful what you wish for. It's actually when the whole world is at your door and you can do anything you want, the problem is picking the right thing to do. Constraints are actually very good for creativity. The hurdles that are in front of us usually help us more than they hurt us. It's hard to get your head around that, but I believe it's true. And so we could resource anything we wanted. We had very unique momentum. We had a lot of market buzz. We worked on supporting all of that concurrently. And it was one of the smartest teams I've ever been on. It was certainly the smartest at that time in my career. Just the people engine at Indigo was uniquely good at bringing brilliant people in, present company accepted. And I worked with some really smart people and we were out to change the world. You can't achieve big goals if your goals aren't big. Like it, unless you get lucky, like otherwise you're just hoping to hit a hole at one. But, you're a golfer. If you go out on the golf course and your goal is 80, then that's what you're thinking about all day. You're trying to figure out how to get to 80. If your goal is to hit 68, that's a different day and a different week and a different month and a different year of training and what you do and how you get coached. And so, we had some terrifying goals, just truly terrifying. But it forces you to break a lot of mental habits and think about how to go get them. So giant goals, brilliant people, and then, a culture that really trained belief in the possible. That's kind of a magical trifecta if you can figure it out. It's really hard to do, and we made plenty of mistakes at Indigo. I haven't been around that company in years, and I don't think we did as well as we possibly could have at the end of the day, looking back years later at some of our performance.
I'm a big fan. There's a book. It's probably one of my favorites. 10x is better than 2x because it's the same level of thinking. When you approach or look at a company, or if you were to mentor a company, how do you look at their markets and help them say, like, listen, you're focused on this, here's what this segment, like, how do you look at it to figure out and even develop, like, is this goal even reasonable at this company?
It's one of the hardest things to do. One of my favorite tricks is to put on different hats and kind of walk around the table. And what I mean by that is when you're in a company that's trying to grow really quickly, your perspective gets very narcissistic very quickly. That's the danger. You start thinking about what you need and what you want and what you have to prove to your investors. And that centering of the bullseye gets dangerous because it means the person you're trying to make happy is your small company. And you don't survive that way. You don't thrive that way. You thrive by making your customers really happy. So you put that hat on. Okay, people are pretty good at that. How do we make the customer happy? How do we provide value? Never good enough. It's way harder than you ever think, and you have to remind yourself that. But then you have to walk around and go, okay, well, what's the market think? How big is this market? What does it mean to change it? What does it mean to show up in it? How would we be a player in this market that makes a difference? Because if you're not going to be a player in your market that makes a difference, what are you doing? Like how do you get out of bed in the morning? Like, so you've got to think market. You've got to think about potential investors and customers and your employees, which is different than your management team. And as you walk around the table, You can actually write different cards and say, I'm going to sit down in this role and I'm going to try and pretend here's what I think about. It's a very gentle version of wargaming. You're going to have some insights that you won't have if all you're thinking about is how do I grow my stake in this company kind of perspective. It's a very dangerous perspective, and it's very enticing. It's super easy to end up there.
You brought up one of my favorite topics when it comes to CEOs is the amount of hats you have to wear, and the people you're accountable to. The one I wanted to dive deeper into today is number one is growth, two is capital, and three is talent. Like you're kind of responsible to making sure all three of those work in harmony. What would you say is the priority of all those three, and how do you sequence them? Where does it change?
Well, day to day, tactically it changes, but I'm very specific about how I think about it as a CEO. So as a CEO, my only job is to create value for shareholders. Full stop. Everything else I do has to serve that goal or it's not worth my time. So if I sit down and I think if what I'm being asked to do today or what I'm making myself do, I don't think it creates value for shareholders, it's not worth doing. From my perspective, that's not always true for everybody else that works for me, but it's definitely true for me. And you think, okay, well, my job is to create value for the shareholders. That means the primary product I've been asked to create is the company itself. And a lot of, especially earlier CEOs, I speak personally, like I didn't think about that. Um, I didn't think about it that way in my early. But the company is its own product, and then the company makes products that make it a great company. When you invest in a share of Apple stock, you're not really buying um, an iPad or a MacBook or an iPhone. You're buying the company that has the capability to put out really good technology with really cool high-end pricing and experience and ecosystem aspects. That's what you buy in a share of Apple. But Apple, to create that, has to think about with teams. What does the Mac look like? And what does the iPhone look like? And what's the ecosystem environment in the App Store? And who do we play well with? And who do we fight with? And then how do we tell our story? And it's really easy to get lost between those two things. The company has products, the company is a product. And most people just aren't comfortable talking about the fact that the company is a product. And I've never quite understood why. We're here to make money for investors, whoever that may be, whether the founders own 100% or investors own 100%. The goal in a capitalistic system is to make money for the shares. And so you've got to think about who you are as a company and what you provide and why that provides value and how you create the cash engine that ultimately stands you apart from everybody else. But, the company is a product. You have to have great products. And to do all of that at the end of the day, the hardest part, talent. It's the messiest. Some people interview great and don't show up the same way 90 days later. Some people struggle to interview and are rock stars. Sometimes they're rock stars, but they don't click with the team. It's such a messy, multivariate problem. The people interactions and culture and how you drive it, and the bigger you get, the harder it gets in a company. Once you get product market fit, nothing matters until you start building revenue. As you start building revenue, then talent becomes, the thing you have to work on most of the time.
Speaking about both those stages, both require a lot of capital, as you learned early in the career. What's it like raising capital? When are the right times? Like, walk through those scenarios of, I think you guys are on a Series C now. What are those different stages that it looks like? And, you know, far too often I see companies don't ask for enough and they run out of gas too early from a great idea. But just give me your perspective on what the right capital stack looks like.
There's there's multiple aspects about raising money. One's obviously, and you alluded to it, where's your company in its life cycle? What do you need and what are you trying to do? It's also then really important to understand where's the market and what's working in the market and where's the sentiment in the market, because markets have highs and lows. Coming out of COVID, the venture capital market froze solid for about 18 months. And there were a number of young companies that died in that freeze that just couldn't make it through. The company I talked about earlier when I was 28 that I founded, one of the key mistakes I made was being undercapitalized. I raised a first slug of money. At that point, it was $1.2 million. I thought I was pretty cool. We got profitable within 30 months, barely, and thought we were really cool. And then the market changed. Well, I hadn't raised additional capital, and my barely profitable status couldn't fund what I was going through. I was undercapitalized. I got caught, and I was done. That's a quick story. It was 5 years of my life that really hurt at the end. But it taught me that you never stop raising capital until you don't need it anymore, which is really interesting because NVIDIA, who's one of the most profitable companies on the planet right now, just announced that they're raising billions of dollars in an additional share offering. So we're watching some of the most profitable companies on the planet right now raise money. That has to force multiple questions. I'll stay away from the market hype question that, we could dive into here, but, you know, being undercapitalized is the fastest way to lose a company, and specifically a CEO slot at a company. Miss payroll and see how long you stick around. Like that's a cardinal sin. And so you always have to think about, am I capitalized correctly? Is now a good time to take some dilution or sell some shares or raise debt, whatever that may be. When you start out young, you're selling a dream and you need people that'll take a bunch of risk and buy a dream as a company young. Then you start to get some groundwork, and now you're talking to people that, okay, I like a little proof and I like to go big. So I'll bet on the fact that maybe you can go big. Then you've got different investors that'll say, okay, you've proven you can go big. Now show me you can keep more pennies on every dollar that you sell. The cash engine and the efficiency and the stability is what I invest in. And there's a life cycle to that curve. And there's unique investors at every stage of that life cycle for, putting money in that like the risk and reward trade-off. And at each stage, you have to ask yourself, am I selling equity or am I raising debt? You prefer to raise debt and not take the dilution of equity. Equity is the most expensive option on the table most of the time, but there's a reason people do a lot of equity financing. People want shares. They find a lot of safety in that.
Do you remember raising that first 1.3 versus like some of the recent raises? Is the rush and the dopamine, is it still the same, or is the context changed now?
So I raised the 1.2, 1.3, 15 grand at a time. It was not something I'd ever do again. There was a unique time in my career. There was unique reasons we did that. It gave me unique control access. There were trade-offs. There's always trade-offs. The Series C we did, with a lead edge capital, a leading growth equity provider in the U.S., one of the fastest growing growth equity firms in the country right now. That's a completely different transaction than what I started out, doing. Um, the tension is still very palpable in deals. When you're going through transactions and deals, you either learn that you like deals or you don't. There's very little in between because they're very intense and there's a lot on the table and something always goes wrong and somebody always gets upset about something. That's just kind of par for the course. And as you get more mature, you get less emotional about the whole thing. You've seen it, you're going to survive, maybe there's other things to do. And if you're up against the wall and you need the transaction to survive, well, then that's completely different rules. Um, that's that's a completely different negotiating stance and capability set. But for most companies, when you're trying to capitalize yourself as you go through the process, you're trying to match the right investors to the right profile of the business, your life cycle stance. Um, and you want the best price possible with the best partner possible. And everybody's looking like that's a lot of perfect things to get right. You're never going to get them all right. A lot of people will tell you that the dollar they invest is worth $1.3 because of all the value they bring. Be very careful about that. I'm not Sure, I always buy into that. There's cases where it's true, but people claim a lot more value per dollar than maybe exists in the marketplace, or they'd automatically be wealthy investors. It's a it's a fight for your business and the investors that can support you at the right time in the right way. And it's their job to figure out the right people to give dollars to, meet their thesis as well. So it's matchmaking, and it's harder than speed dating. Yeah, I think I haven't dated in a century, so maybe that's a bad analogy.
I don't think there's any Tinder for funding yet.
It
It's
probably wouldn't
worked
be pretty.
anyways. Yeah.
Yeah.
So, if you have any case studies or any, stories of bad money, like people just took it in desperation, but that's just the wrong partner, very much like a marriage, I guess. You just rush into something. How does somebody like protect themselves, make sure they don't take bad money?
Um, well, the easiest thing to do to check an investor is to call the people they've invested in. A lot of people don't do it. But, if you're a CEO and you're thinking about taking money and you don't make a couple phone calls to other CEOs that have taken money from that group, then you get what you get. Because they're all going to tell you they're easy to play with. Not everybody is. Some groups are very forward about saying, look, we're into control and we're coming in with a playbook. And other groups will hold back on that information and go, hey, you get to play as long as you want until we decide we're coming in with a playbook. And those are different stories and different outcomes. I think it's all fair game as long as you're transparent and you know what you're getting into. The bait and switch is what scares the hell out of most people. And so you have to be really careful. And if you want to watch out for the bait and switch, call some people they've done some business with. Just a few phone calls will usually take care of that, because patterns are hard to hide in the market, and people will tell you. They'll tell you about pain way faster than they will joy, turns out. But I think that's generally more fear than it is reality. The bad investor, like the I'm here to get you. Uh, Most investors understand that, beating the hell out of a management team is not the path to success. That's not a very good strategy. So I don't worry about that much. I have seen young companies that start to get hot take money at valuations that hang them, that leave no room for any slowdown or any back off. In a really hot market, you get some offers at times and you're like, hey, look what we can do. And you've got to, sometimes it's the right thing to do to take that offer and take advantage of a hot market. There's no one choice in that situation. But you as a company are selling outcomes. And if you don't believe you're credible in what you're selling, you will hang yourself when you don't get there. And the preferred investors take all the common shares and hang everybody else because of their downside protection. And you got to be really careful about that. When you're selling the dream, the Excel exercise you go through to say, here's what I think is possible, is a thought exercise, and nobody quite believes it, and you still have to do it. By the time you get into Series C, hey man, that doesn't work anymore. Like, we're expecting you to hit the numbers you sign up for, or to be able to explain why, or beat them. We're open to the upside. So if you take a deal where everything has to end sunny side up for you to get your investors happy and make money in it, um, you need to be really careful about the risk you're taking on for that, and thoughtful about, and that shows up in valuation. Um, Not, I don't think people talk about that enough, because they all want to, in business porn, they want to celebrate high valuations. Nobody talks about the times when people get hung.
Well, that was my follow up question. Is I see so many people, and I don't know if it's just proliferated from Silicon Valley, but everyone's talking about these 10x or 12x valuations, but they're not talking about what that really means or what the back end deal structure. Do you think that is one of the, well, you talked about like deal porn. What's your perspective on true valuations of companies and what they should really be looking at?
Well, I mean, my favorite valuation ever is discounted free cash flow. You can't do that in early stage companies. They're not there yet. So it doesn't, that's a late stage valuation. It's the safest, most risk averse, easiest valuation metric there is to play with. That's my finance background. When you're in the earlier stages, there isn't free cash flow, or it's not as strong as you want it to be. It's not what you want to hang your hat on. So You've got to be able to value the credibility of the team. Uh, do they know success? Are they pointed in the right direction? Does it seem like they can actually do what they're doing? And a lot of times that comes back to sales pipeline. Like, is it growing? Can they actually close? Can they do it repeatedly? Um, a sales pipeline is where a lot of story meets reality in younger companies because you can talk about everything you want to sell. Well, great. Who are the customers talking to you about wanting to buy it? That shows up in pipeline engagements, and smart investors will call customers very quickly, and they'll call prospective customers, and people don't know about you. And so the valuation very quickly comes down to revenue credibility and team credibility. And that's where you see investors that do a ton of homework, and they've gotten very good at homework. They have full research teams that are just chasing. Are these guys as good as they say? Does the tech work? Are the customers having the experience they say, and are other people lining up to also say that they're happy about it and they want to spend money on it? A lot of times that valuation's coming down to sales performance and pipeline.
This has been so full circle, and there are so many things I would like to continue on. But I want one final question before we get there. What's the best way for people to follow you, follow your journey, follow BinSentry?
Well, I think LinkedIn and our social work that we do at BinSentry is the easiest thing to keep an eye on. We're active there, and we'll keep telling our story to the best of our ability.
I'll make sure all of those are in the show notes. The last question we have today, if you could sit across from the version of you that was just getting started, right before the hardest part, what's the one thing you would tell him?
You prepped me for this one, thankfully, in the pre-read, and I needed that, Doug, because off the cuff, I don't know that you're vulnerable enough on this one. So if I was looking at a young Ben Allen, what I would say is that there's going to be a lot more failure than people tell you, like a lot more. You're going to make more mistakes. You're going to burn more cash. You're going to look dumber than you ever wanted to look more often than you want to. You just have to keep going. Don't believe the business porn and the get rich quick. There is no get rich quick. Just put one foot in front of the other and just keep going, and it'll be okay. You're going to make a lot of mistakes. The trick is not to make the same one twice. So please learn and keep going. That's what I would tell young me.
And this was awesome. Thank you so much for joining us today.
I appreciate it, Doug. It's been a pleasure.